In this topic, we'll unpack how RWA deals are actually put together, who takes risk first, who gets paid first, and where all the fees hide. By the end, you'll be able to look at any RWA pool and know exactly where you sit in the stack, what you stand to earn, and what you stand to lose. Think of the RWA capital stack as a yield farm with built-in shock absorbers. Cash flows from the underlying assets pay the senior tranche first. It's the safest position, so it earns the lowest yield. Next is the mezzanine tranche, taking moderate risk in exchange for a higher yield. At the bottom is the junior or equity tranche. It gets paid last, but absorbs losses first, like a protocol backstop or risky LP position. Where you sit in this stack sets both your APY and your downside. In any RWA pool, tranching boils down to two questions: who gets paid first and who eats losses first. Senior tranches are like ultra-conservative lenders. They have first claim on cash flows, take losses last, and accept a lower yield in exchange for that protection. Junior tranches sit underneath. They take the first losses, which makes them the riskiest, but they're rewarded with higher potential returns and effectively create a leveraged buffer that protects the seniors. Now picture an RWA pool as a fountain. Losses flow from the top of the structure downward. Junior capital sits at the bottom and takes the hit first. It's intentionally designed as a thick loss cushion that absorbs credit losses until it's completely wiped out. Only after junior is gone do losses reach senior capital. That's why senior tranches earn lower yield. They're drier, safer, and only exposed if the entire junior buffer is exhausted. Tranching is also about matching very different investor mandates within a single deal. Senior buyers are the safety-first crowd: institutions, DAOs, treasuries, stablecoin issuers. They want predictable cash flow, low volatility, and are comfortable with mid-single-digit yields. Junior buyers are the risk-on capital: hedge funds, credit specialists, DeFi degens. They willingly accept first loss risk in exchange for much higher APY. The structure lets both groups hold the same pool of assets, but on very different risk-return terms. Now shift from the stack to the cash flows themselves. Think of RWA yield as a long pipe. At the source is the gross asset yield, what the real-world loans or securities actually earn. As that cash moves toward you, different players open their taps. The originator takes a cut for sourcing and structuring deals. Servicers and administrators charge for monitoring, collections, and reporting. Then the crypto protocol adds its fee for smart contracts, liquidity, and distribution. What finally reaches you at the end of the pipe is the net distributable yield. Within that pipe, two quiet but important leakages are originator fees and servicing or admin fees. The originator fee pays the team that finds borrowers, underwrites risk, and structures the deal. It's often a one-time upfront cut of the capital raised. Servicing and admin fees cover the work of running the loan book, collecting payments, handling KYC, enforcing contracts, running audits. Those are typically charged as an annual percentage of outstanding assets before any yield is passed on to investors. On top of that, RWA products usually layer in protocol fees. Treat these as the first on-chain drain on gross yield before anything gets to you. Smart contracts automatically siphon part of the cash flow to pay the platform, token issuers, and liquidity providers. From there, a slice often goes to the DAO treasury for runway, or token buybacks, and another to a reserve fund for insurance. All of this can be useful, but it's still yield leakage you need to subtract when estimating your true net return. Putting it all together, think of yield as flowing through a funnel. The borrower might pay 15% on the underlying asset. Before you ever see that, off-chain providers like the originator and servicer take their fees for sourcing and managing the loans. On-chain, the protocol and governance take their cut as well. What's left is the net distributable yield. That amount then gets allocated by the capital stack. Senior tranches are filled first, and junior tranches receive whatever remains. Now let's walk through a simple end-to-end deal structure. Think of four roles working together. First, the originator is a fintech lender. They find and underwrite real-world SME loans in fiat. Those loans are sold into an SPV, a legal shell that's bankruptcy remote. The SPV actually owns the loans and is the entity that can issue tokens against them. The RWA protocol connects this SPV to DeFi, providing smart contracts, governance, and distribution rails. Finally, the borrowers are the SMEs using the fiat capital funded by your deposits. Next comes the fundraising and tranching. DeFi users deposit USDC into the pool. The structure then splits that capital into two tranches: an 80% senior piece with a lower, say 7% target yield, and a 20% junior piece with a higher, 15+% target yield. Junior investors take first loss, so they demand more return. All of the pooled capital flows into the SPV or protocol wrapper, passes through a crypto to fiat bridge, and the originator ultimately uses the fiat to fund real-world SME loans. As the loan season, think of money flowing back through a stack of promises. Borrowers repay in fiat. First, everyone upstream takes their cut: originator fees, servicing, and protocol fees. What remains then hits the senior tranche, which has a fixed 7% target. That target is filled before anyone else participates. Only after seniors are fully paid does extra yield spill into the junior tranche. Juniors get boosted APY, but they're also the shock absorber. If loans default, junior returns disappear first, and their capital is consumed before senior principal is touched. Once capital is deployed into an RWA pool, the real work becomes monitoring and lifecycle management. You're tracking performance data: defaults, LTVs, utilization, reserves. Those metrics feed into covenant checks. Are borrowers and servicers still operating within the rules you agreed to? As loans repay, the structure decides whether principal gets recycled into new deals or returned to investors via token redemptions. Finally, at maturity or early exit, you're managing repayments, any unexpected extensions, or selling exposure on secondary markets. When you encounter a new RWA deal, run 4 quick checks. First, locate your position in the capital stack and identify who loses money before you. Second, strip out every fee, off-chain and on-chain, to reveal the real net yield. Third, assess how thick the junior protection is relative to the overall pool. Finally, stress test the legal structure and enforcement, so you understand not just the returns on paper, but how they're actually protected in the real world.